Hey, small business owners, welcome to our guide on maximizing your Section 199A deduction in 2023. It's been a whirlwind of change this year, and amidst this all, we want to make sure you're not overlooking a crucial aspect of your business. So today, we'll navigate through the ins and outs of Section 199A deduction to ensure you're making the most of this valuable tax benefit. So let's start with the basics. The Section 199A deduction, a gift from the Tax Cuts and Jobs Act, offers pass-through businesses a straightforward 20% tax deduction based on defined business income. But there are nuances you shouldn't ignore. So imagine you have $100,000 in defined qualified business income, or that's QBI, and $100,000 in defined taxable income. Congratulations, you qualify for a $20,000 Section 199A deduction on your Form 1040. Great thing about this, you don't have to lift a finger to get this deduction. But here's the catch. Tinkering with your business income through tax planning might impact your deduction. For instance, buying $40,000 worth of equipment and expensing it could lower your QBI to $60,000, reducing that 199A deduction to $12,000. And if your 2023 QBI exceeds $182,000, if you're filing single, or $364,200 on a joint return, buckle up. Your Section 199A deduction game requires more attention. So let's delve into the three strategies you can implement before December 31st, 2023 to make sure you're making the most of your Section 199A deduction. Okay, first thing is capital losses. You need to harvest capital losses to reduce taxable income. Capital gains add to your taxable income, and your Section 199A deduction depends on taxable income. If capital gains are a headache, consider harvesting capital losses before the year end to offset these gains. The 2023 Section 199A calculator is your friend here, helping you navigate these intricacies. Now, strategy number 2 is to make charitable contributions to reduce taxable income. Since the Section 199A deduction hinges on taxable income, leveraging itemized deductions can work in your favor. Charitable contributions are a simple way to increase itemized deductions. Donate appreciated stock or pre-planned 2024 charitable contributions before December 31st, 2023 to claim deductions this year. Now, strategy number 3, buy business assets. Thanks to Section 179 expensing, you can write off the entire cost of most business assets purchased and placed in service before the end of the year. This move can help lower your taxable income and contribute to an increased Section 199A deduction. Let's see these strategies in action with a couple of examples. So example 1, Susan, facing capital gains challenges, chooses to donate appreciated stock. This is not only increases her itemized deductions by $20,000, but also drops her taxable income, saving her $6,190 in income taxes. And now let's say Jim, who owns an S Corp, faces a Section 199A deduction of $0 due to high taxable income. Buying and placing $30,000 worth of medical equipment in service before the year end changes the game. So you will have to buy equipment that's related to your business, and we're going to assume that Jim owns a medical practice. So this not only reduces taxable income, but boosts your Section 199A deduction by $26.88, which will help Jim on his tax bill. So here's some key takeaways. Your 2023 taxable income is above $182,100 or $362,200 on a joint return. Your Section 199A deduction might be at risk. So harvest capital losses, make charitable contributions, or buy business assets before the end of the year to reduce taxable income and maximize your Section 199A deduction. Remember, the Section 199A deduction can be tricky, so use a good Section 199A calculator to ensure you're on the right track. Don't let this valuable deduction slip through the cracks. Take action now for a smoother financial journey for the rest of the year. Thanks for joining, and drop me a line if you have any questions related to taxes and ways to save money on your return.